Imagine this, you're a business owner. You've built something from the ground up, years of sacrifice, hard work and sleepless nights. But now you need funding to grow, to survive, to keep your dream alive. So you walk into a bank, you sit down, shake hands with the loan officer, and present your case, and then, denied. Not because your business isn't good, not because you lack vision, but because banks are closing their doors to businesses like yours. You leave the office, frustrated, feeling stuck. The doors to traditional finance are shutting. But somewhere in the background, a new financial empire is rising. Welcome to the Profit Report, your headquarters for decoding the biggest financial shifts shaping our future. Enter private credit, the $2 trillion market taking over. A hidden network of investors, hedge funds, and private equity firms is stepping in where traditional banks have pulled back. They don't operate under the same rules, they don't have the same oversight, and they're making billions. But here's the question, is this the future of finance, or a ticking time bomb? Because history has shown us, whenever money flows too freely, things tend to break. And when they break, it's the little guy that gets crushed. The silent crisis businesses face today. Banks are retreating, lending standards are tightening, small and medium businesses are struggling to access capital, investors are hungry, big firms are stepping in, filling the gap, but with high-risk loans and little oversight. FOMO is rising. Pension funds, hedge funds, and institutions are all scrambling to get a piece of this booming market. This is not some niche finance topic. This is a fundamental shift in the global economy. Imagine you're an entrepreneur with a groundbreaking idea, poised to disrupt your industry. Traditionally, securing funding would involve navigating the stringent requirements of conventional banks, often a daunting and restrictive process. Enter private credit, a more flexible, tailored financing solution that not only provides the necessary capital, but also aligns with your unique business needs. Recent developments underscore the significance of private credit in today's financial ecosystem. For instance, M&G's acquisition of a 70% stake in Stockholm-based P Capital Partners highlights the strategic moves by investment firms to bolster their presence in private markets. This deal, expected to complete in mid-2025, aims to expand M&G's existing £73 billion private markets business, reflecting a broader trend among asset managers to enhance their capabilities in this growing sector. Moreover, the private credit market's resilience amid macroeconomic challenges, such as the pandemic and fluctuating interest rates, has been noteworthy. Recent rate cuts by the Federal Reserve and the European Central Bank have boosted optimism, with increased fundraising and deal-making anticipated in 2025. However, concerns linger about future performance, as lower spreads and mechanisms to aid borrowers during high-rate periods may impact yields. For investors, private credit offers an avenue to diversify portfolios and achieve higher yields compared to traditional fixed-income assets. The asset class has become extremely popular in recent years, causing the size of the market to rise rapidly. However, with opportunity comes responsibility. Regulatory bodies are intensifying their scrutiny of private markets to ensure transparency and mitigate potential risks. The UK's Financial Conduct Authority, for instance, has conducted in-person visits and issued extensive surveys covering valuation practices, governance, and risk management within private markets firms. This initiative aims to ensure robust regulation and transparency in an expanding sector, particularly as traditional banks retreat from certain lending activities, leading private capital giants to fill the gap. Similarly, in Australia, the Australian Securities and Investments Commission is examining the unregulated and rapidly growing private lending markets, aiming to increase oversight due to potential risks to retirees and investors from opaque valuations and limited disclosure. This move underscores the global recognition of the need for better regulatory frameworks as the private credit sector continues its rapid expansion. In essence, the rise of private credit is not just a shift in financial instruments but a transformative movement that affects entrepreneurs seeking capital, investors pursuing diversified returns, and the broader economy striving for growth and stability. Embracing this evolution offers opportunities for innovation and financial prosperity, but it also necessitates a keen awareness of the associated responsibilities and risks. As we stand at this crossroads, the call to adventure beckons. Whether you're a business leader, an investor, or someone intrigued by the dynamics of modern finance, understanding and engaging with the private credit market can open doors to new possibilities and drive impactful change in the economic landscape. What's driving this boom? Investors are desperate for yield. With bonds and stocks unpredictable, private credit offers high returns. Businesses are locked out of traditional banking. Banks have become risk-averse, so companies have no choice but to turn to private lenders. Hedge funds and private equity firms see blood in the water. The biggest players aren't waiting, they're going all in on private credit. But here's what no one is telling you: with no regulation and no safety net, this market is becoming dangerously fragile. The desperation and fear of missing out. Imagine being a small business owner today. Your competitors are getting funded, not by banks but by private lenders who charge high fees and interest rates. You know you need capital to compete, but the only options left come with hidden risks. Or imagine being an investor. You see big institutions making billions, and the fear of missing out creeps in. Everyone is making money. You're sitting on the sidelines. That's how bubbles form. And every bubble ends the same way. The hidden dangers of private credit. Liquidity risk. Private credit is not like stocks or bonds. It's difficult to exit, making it fragile. Rising defaults. If businesses can't pay back loans, investors get crushed. Lack of regulation. Unlike banks, private lenders aren't required to hold reserves or disclose risk. Over-leveraging. Many private loans are structured for high risk, meaning small downturns can trigger mass defaults. We've seen this before. Housing crisis of 2008. Tech bubble of 2000. Savings and loan collapse of the 1980s. What makes this time different? Nothing. The signals that this could collapse. Pension funds increasing private credit allocations by 50%. Banks trying to get back in after missing early growth. Macquarie shutting down traditional debt services to pivot into private lending. Whenever we see a rush of capital into a single asset class, history tells us, it won't end well. What if it all goes wrong? Every financial venture carries inherent risks, and the private credit market is no exception. While the growth of this sector offers numerous opportunities, it's essential to consider the potential pitfalls. One significant concern is the lack of transparency and regulation in the private credit market. Unlike traditional banking systems, private credit operates in a more opaque environment, which can obscure the true level of risk involved. This opacity can lead to mispricing of risk and, in extreme cases, financial instability. The rapid expansion of private credit has also led to looser lending standards in some instances. As firms compete to deploy capital, there's a temptation to underwrite riskier loans without adequate safeguards. This behavior mirrors some of the practices that contributed to the 2008 financial crisis, where excessive risk-taking without sufficient oversight led to widespread defaults and economic downturn. Moreover, the interconnectedness of the financial system means that troubles in the private credit market can have broader implications. If a significant number of borrowers default, it could lead to a cascade of losses, affecting not only lenders, but also investors and other financial institutions. This scenario could erode confidence in the financial system, leading to tighter credit conditions and a slowdown in economic activity. Recent events have highlighted these risks. The collapse of Sten, a fintech startup once valued near $1 billion, serves as a cautionary tale. Allegations of links to Russian money laundering and the subsequent fallout have left creditors facing substantial losses, underscoring the potential dangers inherent in the private credit market. In light of these risks, it's crucial for investors and stakeholders to approach the private credit market with caution. Conducting thorough due diligence, demanding transparency, and advocating for appropriate regulatory frameworks can help mitigate these dangers. By being aware of the potential crises that can arise, you can make informed decisions and contribute to a more stable financial environment. The opportunity for smart investors. In every financial shift, while some investors panic and get wiped out, others seize the moment and position themselves for massive gains. The private credit market, despite its risks, presents an opportunity for those who can navigate its complexities strategically. Early movers secure the best lending deals. As traditional banks retreat, private lenders step in to fill the gap. Investors who enter early can negotiate higher yields and favorable terms before the market becomes saturated. Institutions like Apollo and Ares Management are already deploying billions capitalizing on this transition. Businesses that structure debt correctly will survive the downturn. Not all debt is bad. Companies that use private credit strategically, securing flexible, non-dilutive funding, can strengthen their position while competitors struggle under rising interest rates and tougher lending conditions. Those who prepare now will be the ones standing strong when others falter. Smart investors wait for the shakeout, then buy in when prices collapse. Market corrections are inevitable. As liquidity tightens and weaker players fold, well-capitalized investors can step in at rock-bottom prices. Whether it's acquiring distressed debt, investing in undervalued firms, or launching private lending ventures, those who wait for the right moment will reap the biggest rewards. The financial landscape is shifting. Those who act with insight and patience will turn uncertainty into opportunity. Will you be one of them? The biggest takeaway. Private credit is here to stay, but its explosive growth comes with massive risks. If you're a business owner, know your options before jumping in. If you're an investor, understand the dangers before chasing high yields. This market will create winners and destroy those who don't play it right. How you can stay ahead. The private credit market is rapidly evolving, and those who stay informed will have the upper hand. Whether you're an investor, a business owner, or simply someone trying to navigate the shifting financial landscape, understanding these key steps can help you stay ahead of the curve. Step 1. Stay ahead of the news. Big institutions are making moves daily. The biggest players in finance, hedge funds, private equity firms, and institutional lenders, are not waiting. They're deploying capital, acquiring competitors, and reshaping the credit landscape in real time. Actionable insight. Follow financial news sources like Bloomberg, Financial Times, and the Wall Street Journal. Pay attention to regulatory updates. Governments are starting to intervene in private lending markets. Track major deals and acquisitions in private credit. These signal where the money is flowing. Why this matters. When the big players make a move, it affects everyone. Understanding these shifts early means you can anticipate opportunities and avoid pitfalls. Step 2. Know the risks. Don't let fear of missing out push you into bad investments. When an asset class starts booming, investors rush in, driven by fear of missing out. But the most successful investors know that every market boom eventually cools off, and those who get caught up in the hype often pay the price. Common traps to avoid. High-risk loans with no clear exit strategy. If liquidity dries up, you could be stuck. Over-leveraging, borrowing too much at high rates can backfire in a downturn. Lack of transparency. If you can't see the risks clearly, it's probably a bad deal. Smart moves. Do your research. Look at default rates, company fundamentals, and the terms of private loans. Have a long-term plan. Chasing quick returns often leads to bad decisions. Don't follow the herd. Just because everyone is piling in doesn't mean it's a good idea. Why this matters. The biggest market crashes in history happened when investors ignored risks. The 2008 financial crisis was fueled by bad debt. Learn from the past. Don't let the excitement of private credit blind you to its dangers. Step 3. Prepare for market shifts. Because the easy money won't last forever. Financial markets never stay the same. What's booming today can collapse tomorrow. The key to long-term success is being prepared for change. How to stay ready. Diversify your investments. Don't put all your money into private credit. Monitor interest rates. Rising rates can crush borrowers, leading to defaults. Build liquidity. If a downturn hits, having cash on hand lets you buy when prices crash. Why this matters? Many investors only react after the market shifts. The smart ones prepare in advance, positioning themselves to take advantage of downturns instead of being wiped out by them. Bottom line, private credit is a game of strategy, not luck. If you stay informed, avoid reckless risks, and prepare for shifts, you'll be ahead of 99% of investors. Preparing for what's next. If you're a business owner, know your options before borrowing. If you're an investor, don't get blinded by the hype, because when the market corrects, and it will, only those who are prepared will thrive. Want to know the real winners in this financial shift? Banks are struggling. Investors are thriving. The private credit wave is reshaping finance, but only those who move early will profit. Watch rise of private credit, why banks are losing and investors are winning. Click above before the window closes.